Now, first of all, we are going to learn the definition of business economics. First, let's read out what is written in the screen. Business economics is the discipline which helps a business manager in decision making for achieving the desired results. In other words, it deals with the application of economic theory to business management. Now, when we are saying business economics, it is a discipline which are mainly for decision making for the achieving the desired result. What is the desired result? Means the objectives of any kind of business. Business economics uses the theory of economics, like some of the more important theories which is given in economics are like demand, law of cost, law of production. All these are under your economic theory, but those theories we are going to learn in your other units. So for the time being, what is business economics? Business economics is a decision-making process for achieving the desired result with the application of economic theories. All the theories we are going to discuss in your later classes. It helps the management in taking right decision at right time to achieve the objectives of the business. So hope we all are clear. Business economics is the discipline which is helping us to make decisions with the application of economic theory for achieving the desired results. Now, according to Spencer and Seligman, what business economics they have defined. Whenever the definitions are given by some authors, you have to be very careful with the quotation marks, because you cannot skip any words which has been defined by the author. So according to Spencer and Seligman, how business economics is defined? It is defined as the integration of economic theory with business practice for the purpose of facilitating decision making and forward planning by management. What is planning? Why this planning is called as forward planning? Because planning is done in advance. We are doing planning for the future, to know how we are going to achieve our goal in the future. That's why it is called as forward planning. As I have told you in this definition also, the business economics helps the manager in decision making to achieve the goals of the organization through the application of economic theory. They make use of economic theory. What were the economic theories? Those are the demands, law of demand, law of cost, law of production, etc. So hope we all are clear with the definition. This is the simple definition. You can alter it if you are writing in on your own words. But if it is given according to some authors, it have to be written as it is given in the definition. Next, we'll see the managerial economics. Now, managerial economics and business economics, it is the same thing. You should not be confused with the words managerial economics and business economics. Managerial economics is also known as business economics. Now, why it is called managerial economics or business economics? Because it helps the managers to take right kind of decision at the right time. Now, what is this managerial economics said? Managerial economy consists of that part of economic theory which helps the business manager to take rational decision. Now, what is this rational means? Rational means careful decisions or right decisions to be made by the managers in the organization. Why the decisions have to be careful? Because if managers don't take careful or right decisions, the objectives of the business might not be able to achieve. Now, economic theories help to analyze the practical problems faced by a business firm. Why we use economic theories in the business? Because we need to find out the practical solutions for these problems. What will be the condition of prices? What will be the condition of demands? What will be the conditions of supplies? We have to take into consideration all the aspects of business That's why we are using these economic theories for practical purposes. Next, managerial economics integrate economic theory with business practice. Integrates economic theory with business practice means they are joining together to, or they are using the economic theories which are already mentioned in the economics subject. Those theories they make use. Who make use of it? The managerial economics make use of the economic theory for making their business successful. They use the economic theories given in the economic subjects to make the business successful. Next, it is a special branch of economics that bridges the gap between abstract theory and business practice. Now, in this, why it is called as a special branch of economics? Because specifically we are mentioning that this economics is for the business. Managerial economics is mainly for the business, right? So if it is for the business, whatever functions to be performed in the business have to be undertaken in this managerial economics. That's why it is called a special branch of economics. I'll repeat again why it is special branch of economics. It is special branch of economics because we are specifically mentioning the business term, that is your managerial economics or business economics, to make the functions of business workable. It deals with the use of economic concepts and principles for decision making in a business unit. It is otherwise called business economics or economics of the firm. Now, same thing, it has been written here also that when we are saying business economics, we are mainly talking about decision making of the business with the help of economic theories or concepts. Next, moving on to the next slide. Characteristics of business economics. Now, what are the characteristics of business economics? Characteristics, you can say the features of business economics. Now, we can see here, I have given you so many characteristics, so we have to discuss. I'll be discussing with you all these characteristics one by one in detail. Now, first one is microeconomics. Now, microeconomics is what? Let's see first. Managerial economics is microeconomic in character. This is so because it studies the problem of an individual business unit. Now, what do you understand by individual business unit? It is for a particular unit. Now, what is this particular unit? Let's say we have an organization which is producing soap or furnitures or shoes. So, these are all separate units, right? So, for these all separate units, like if we are looking the business of soap, it will be different from the business of furniture. It will be different from the business of shoes. So for this reason, this managerial economics as a microeconomic factor, we take only into consideration the units of the business, individual units of the business. Like for the organization of soap making, that is a different methods we'll be using because the process is different. Next, for the furnitures, we will be taking a different business unit. For this, we have different problems, different steps to be followed, and so on. So what is microeconomics? Microeconomics is mainly for the individual business unit. These are the key points which you need to understand. Microeconomics, it deals with the problems of an individual business units. Next, normative science. Now, what is normative science? It develops the ways to achieve these goals. What is these goals they are talking about? These goals means what are the problems faced by the organization and how to solve those problems by taking a correct decision to achieve the goals. These are called normative science. Next is pragmatic. Managerial economics is pragmatic. Pragmatic means it is a learning by doing. Pragmatic means to discover something. It concentrates on making economic theory more applicable, more application oriented. It tries to solve managerial problems in their day-to-day functioning. So, pragmatic means the experience, what you gain in the real world. Suppose if you are having any kind of problem, how you will fix it then and there. Those are the pragmatic. Now, how managerial economics is pragmatic? It tries to solve the managerial problems in their day-to-day functioning. Now, how to understand this day-to-day functioning? Let's suppose if you have any kind of problems in the class. Suppose someone is quarreling, you try to take action for how to solve this problem, why they are quarreling, what is the reason behind that. So you try to solve those problems. So same way in business also, when we are saying about pragmatic, we take the help of the economic theories. We take the help of economic theories to solve the managerial problem in the day-to-day functioning of the business. Hope it's clear. Let's move on to the next slide. Uses macroeconomics. Now, what is uses macroeconomics? Microeconomics, I have told you. What is microeconomics? It deals with the problem of individual business unit, right? So when we talk about macro will not be related with only one business unit. It will relate with all the external conditions of a business. Those who are outside the business. Which are the conditions which are outside the business, like the business cycle, national income of the country, economic policies of the government, etc. Macro is bigger term or wider term than the microeconomics. Microeconomics is dealing with the single business unit to solve the problem of single business unit, and macroeconomics is dealing with the external conditions like business cycle, national income, economic policies of government, etc. So micro is, when we say the difference between micro and macro in a single term, what does it mean? Micro is for a single purpose and macro is for a bigger purpose. Next, uses theory of firm. Now, uses theory of firm, as I have already mentioned to you, that managerial business or business economics, they uses the theories of economic subject. Why they try to use the theories of economics? To solve the business problems. So uses theory of firm means they are using the special branches of economics to help the managers take decisions to solve the problems. Next is management oriented. Why it is management oriented? By the name itself, it is very clear, because we are talking about the business economics or managerial economics. Business economics is always related with management. What are the particular management functions which we know? Very popular functions of management. Those are all the 5 functions, that is your planning, organizing, directing, controlling, and staffing. But in this managerial economics, mainly we are concerned with taking the correct decision, that is the directing function of management for the decision making for the future. So moving on to the next slide. It is multidisciplinary. Why it is multidisciplinary? Managerial economics makes use of most modern tools of mathematics, statistics, operation research, in decision making and planning principles such as accounting, finance, marketing, production, and personnel, etc. It is multidisciplinary because it contains some parts of all the parts of mathematics, statistics, research, accounting, finance, marketing, production, personnel. Personnel is the staff, people. So, managerial economics makes use of all these subjects in the form of theories to get the desired objective of the business. So that's why it is called multidisciplinary means it consists of many other subjects, including many other subjects. Next is art and science. Now, when we say managerial economics, is managerial economics science or art? So we say in that managerial economics is both a science and an art. Why it is science? It is science because they try to find out practically what is the problem of the business. Why it is said art? Because they use theories of economic subject. That's why it is both art and science. Hope you all are clear. It is managerial economics is both science and art. Why? Science. Why it is science? Because it is practical in nature. They try to find out the problems through practical knowledge. And why it is art? Because we make use of the theories of economic subject. Next, moving on. Now, next is your scope of managerial or business economics. What are the scope of managerial or business economics? So you can just term it as business economics. You can refer to as business economics or managerial economics. It is the same thing. So now we are going to see this scope of managerial economics. First is demand analysis and forecasting. Demand analysis and forecasting. For this, you need to understand what is demand. Let's just read out first what is given. The foremost aspect regarding scope is demand analysis and forecasting. A business firm is an economic unit which transforms productive resources into saleable goods. Demand forecast serves as a guide to the management for maintaining its business share in competition with its rivals, thereby securing its profit. Now, what is demand analysis and forecasting? This demand analysis we'll be discussing in your further slides in detail, but for the time being, you need to know what is demand. So I'll tell you in brief what is this demand. Demand means anything you desire to purchase. Anything you desire to purchase, and at the same time, you need to have the resources to purchase it. Okay, now let's take an example for understanding the meaning of demand. Let's say you want to buy an iPhone and the price of the iPhone is 2 lakhs. So your demand, your will, your want, your desire is what? Your desire is to buy the iPhone, right? But if you don't have that money, that is 2 lakh rupees with you, will you be able to buy that iPhone? No, right? So if you are not able to buy that iPhone, that will not be called as demand. Now, same example if I take, if you want to buy an iPhone whose cost is 2 lakh rupees, and at the same time you want the iPhone and you are having 2 lakh rupees to purchase that iPhone, then it becomes demand. Hope it is clear. I'll repeat again, demand means whatever you desire or whatever you want to purchase, you want to buy, you need to have the money to buy that product. So that is demand. Demand analysis means how to check, how to see, how to know what is your demand, what is your analysis. Now, what is forecasting? Forecasting means to predict something for the future. Predict something for the future. Now, when we are talking about managerial economics as a scope, it is the demand analysis and forecasting. It is the main important, the primary important functions or the scope of business economics. That is, you should know what is your demand, how you are analyzing your demand, and how you are trying to forecast what is needed by you in the organization. So in the management term, if we say, it will be regarding the management, what management wants and how much they can buy. That is your demand analysis and forecasting. Next scope is cost and production analysis. Cost and production analysis, cost, as you all know, it is the price of the product which you have to pay. Or any workers, if you are engaging in the organization, how much salary you need to pay, what are the costs, what are the expenses, everything have to be related with the cost. Whenever you are buying raw materials, whenever you are paying salaries to the workers, whenever you are paying the rent of an office or organization or the business, all these will be under your cost. Now, production analysis is mainly related with your production section, which they are saying how much, what departments you are going to implement in the organization and how you are going to produce those products. Because in any kind of business, whenever we are talking about business, there is always a cost and production involved in the business. So now let's read this. A firm's profitability depends much on its cost and production. A wise manager would prepare cost estimates of a range of output, identify the factors causing variation in cost, and choose the cost minimizing output level, taking also into consideration degree of uncertainty in production and cost calculation. Now, I'll just reflect one thing out here is cost minimizing output level. What is cost minimizing output level? It is the level whenever the firm, whenever the organization is trying to run its business, they must keep their cost at minimum. If your cost is more than your profit, you will not be able to earn any profit, right? So for that reason, the organization, the business needs to minimize, to keep the cost at the minimum so that the organization can earn profit in the future. So next, pricing, decision, policies and practices. Pricing, decision, practices and policies. What is this saying first? Let's read. Firms' income and profit depend mainly on the price decision. The pricing policies and all such decisions are to be taken after careful analysis of the nature of market in which the firm operates. Pricing, decision, policies and practices. Pricing decision means deciding the price of the products. Whenever the price of the products are decided, it have to be very, very carefully done. Policies are those rules and regulations which the organization needs to use or follow. Practices are how they practically uses those rules and regulations and how practically they take the decision. It is all included in this point. Next is profit management. How do we manage the profit? The main aim of a business, any business, if you say, it is the main aim is to earn the profit. But how to manage the profit will be under your profit management. Let's read. The more successful a manager is in reducing uncertainty, the higher are the profits earned by him. It is therefore profit planning and profit measurement constitute the most challenging area of business economics. Now, profit management, whenever we talk about this part of scope of business economics, how to earn the profit, it depends on the manager's decision. They have to see how the profits have to be planned, how much profit they are going to earn in the future. All the crucial decision need to be taken by the manager, and it is very, very challenging for the manager to take decision regarding this. Because if any problem is there in decision making for the setting the profit range of a business, in the future they might suffer losses. Next is capital management. Capital, as you all know, these are the assets of the business or the properties of the business. Investment, mainly you can say that investment of a business, these are the capital. Capital management are investment made in the plant and machinery and buildings which are very high. Therefore, capital management requires top level decision. For making decision of how much investment you need to make in buying a machine, in building a organization, in buying any kind of fixed assets, where you need to make the main investment. It is very, very important, and these kind of decisions are always made by the top level decisions. I hope you know what are the levels of management. There are 3 levels, that is the top level, middle level, and the lower level. So the capital management decision will be taken by the top level managers, not by the middle and not by the lower management. Next slide. Inventory management. What is the term inventory means? Inventory means what stocks you are having in your business. Stocks can be related to your materials. Whatever materials you have, how much stock you need to keep in the business is about management, inventory management, how you are going to manage the inventories. A firm should always keep an ideal quantity of stock. Ideal means it should not be more, it should not be less. It should be perfectly available in the management. If the stock is too much, the capital is unnecessarily locked up in the inventories. At the same time, if the level of inventory is low, production will be interrupted due to non-availability of materials. So whenever we are having stock in the management, in the organization, it should be of ideal quantity. Ideal quantity means it should not be too much, it should not be too less. If it is too much, what will happen? The stocks will be just kept in the organization without using it, and it might get spoiled. And if it is too low, what can happen? That if it is too less, because of non-availability, since it is not available in the organization, the production will be stopped or interrupted. Next is business cycles. Now business cycles, you need to understand business cycle. They have 4 or 5 cycles here. What are the 5 cycles in business are depression, recovery, prosperity, boom, and recession. They all refer to regular fluctuation in economic activities in the country. Now what is this cycles all about? These cycles, whenever there is a business, do you think that a business can earn profit throughout the years to come? No, because when we are looking at the organization, sometimes an organization may have a good profit, sometimes they might have a less profit, sometimes in some cases they might suffer some loss also, right? So in that case, what happened? They have to think how they are going to manage these cycles. What is this first cycle they are talking about? Depression. Depression means when the business is not earning any profit. They are in a depression that how the organization is not earning profit. Why they are not earning profit. So this is a first case of depression. Depression means they are facing some problems for running the business to earn profit. Recovery. Recovery means when the business is slightly going up to recovery stage. That means instead of earning no profit, they are slowly they are trying to earn little profit. Prosperity is again little bit more amount of profit than the recovery level. And boom is the level where the organization is shining like anything, and they are having more profits, and they are becoming good in their management. So this is known as a boom. And recession. Now recession is again going down. After earning profits, they are going slowly down. Again, it will lead to this recession. After this recession is finished, Then the cycle will keep going back to depression. After recession, they'll come back to depression. Again, they will recover. Again, they'll prosper. Again, they will boom. Then again, this cycle will keep on going until and unless the business is stopped. So what is the first step is depression where they don't earn profit. Recovery, slightly getting profit. Prosperity, better profit. Boom, they are earning more profit. It is shining profits they are getting. And recession, again they are coming down. After recession, they are again going back to depression, recovery, prosperity, boom. So this is what is business cycle. Hope it is clear. So this is the end of the class. Hope you have liked it. And if you have liked it, please like the button, subscribe and share it. Thank you.